In this short video, I want to take on the impact that decisions about debt and derivatives have on the return you get from funds. Two factors worth bearing in mind and two questions to ask before you buy a particular fund. So, with no more ado, what is gearing? It's the ability to enhance returns. Now you might think, well, why would I want to ask about that? Because it comes as a two-edged sword. Gearing will boost returns if the fund manager gets things right, and it will also accelerate losses if they get it wrong. I'm just going to demonstrate how. I want you to bear in mind there are two ways of achieving gearing: via debt, borrowing, and via derivatives. Now this is not a derivatives video, it's also not a long video, so I'm just going to give you the real basic bare bones, and we'll explore derivatives in other videos in more detail. Okay, debt first. So, choice of two funds. And if this goes a little quickly for you, do see the other video, what are open and closed-ended funds first. So let's assume on the left-hand side we have something which is open-ended. I'll just call it OE. So that could be a unit trust, open-ended investment company, 100% equity funded to the tune of £100,000 of assets. On the right, next door to it, let's have a closed-ended fund, a CE, open-ended, closed-ended, so an investment trust company, for example, 50% debt funded. So there it is. In green, you've got the debt. In black, you've got the equity. Also, assets of £100,000. Now, what's going to happen is, here's the good news. The assets under management are going to double. Let's see what effect gearing has. Now remember, you tend to get gearing more often in closed-ended vehicles because some of the limits that apply to open-ended vehicles on borrowing don't apply. So let's assume in the open-ended fund, assets under management double up to 200,000. Bang, there it is. It's all in black, that column, because all of that return belongs to the unit holders, or if it's an open-ended investment company, the shareholders. In other words, not bad. Doubling net assets doubles, if you like, what belongs to the people who put their money into the fund. Okay, but on the right-hand side, look what happens. Because you've got fixed debt, because the amount of debt is fixed, if assets under management also double with a closed-ended vehicle, just look at that. Basically, rather than doubling your money, all right, technically your ownership right is increased threefold, thanks to gearing. So in a good year, assets increasing, you've got a much better overall return in the vehicle on the right. And that explains why in bull markets, traditionally, if you look back, investment trust companies have tended to outperform their equivalent peers, open-ended, with almost the same investment strategy. It's the gearing that adds to the returns. But watch out, because before you rush out and think, well, I'm going to look for a strategy and I'm going to buy it through a closed-ended vehicle because returns are better, be careful. Gearing is a two-edged sword. If things go wrong, watch what happens. Supposing the assets didn't increase to 200,000, they dropped to 50, halved. What would that look like? Here goes the dotted line. If I put a line in just here, okay, now it's bad news in both cases, but in the open-ended vehicle, equity holders, as I'm calling them, unit holders, have seen 50% of the assets and therefore their investment wiped out. In the closed-ended vehicle, it's worse than that because all that's left is 50,000 of assets. So if you liquidated that vehicle, not saying you always can liquidate closed-ended vehicles just like that, but if you liquidated it, all you'd have is enough money to pay off the debt. So you've wiped out the equity side of the equation. All right? So you've suffered 100% losses as against 50%. So there's the point. Gearing in the form of debt accelerates returns in good years, crushes them in bad years. Now, there's another way of achieving gearing. I mentioned it briefly. Other videos will do this in more detail, and that's derivatives. This is going to be the real bare bones. Some fund managers, whether they're running open or closed-ended vehicles, use derivatives to enhance returns. And just watch out here. So imagine you're a fund manager. All right, you've got £1,000 to invest, and you've got three choices. You could buy shares for £1 each. You could put the £1,000 into futures. It's a geared product. Or you could invest the £1,000 in an option, pay a premium, a bit like an insurance policy, okay, to buy an option. Right. Now, those are your three choices. So this time I'm looking at not gearing and gearing, so not using derivatives and using derivatives. So the share price doubles and you own 1,000 shares. Fantastic. Your profit is £1,000. All right, because the share price has doubled. Put 1,000 in, you've got 2,000 at the end. The point about using derivatives without going through any of the detail is you potentially could make almost unlimited. You can make much bigger profits than £1,000 with both futures and options. You can accelerate your returns. You might be thinking, brilliant, so let's go and look for fund managers who are playing with derivatives most of the time. No, because there is a price for everything. There are no free lunches in investing. So here's the problem. If the share price halves, the person who bought 1,000 shares has lost, ignoring transaction costs and so on, half the amount. So they had £1,000 worth of shares, share price halves, they've got £500 now. The person who used the £1,000 to play around with futures and options, you don't have to understand any of the mechanics of these things to realise there's a problem here. With futures, could be facing a much bigger loss. Okay, there are ways of reducing it, but a much bigger loss than £500. Okay, and with options, well, the advantage of options is you pay a premium up front, and if things go wrong, you lose the premium. It's a bit like your car insurance. You don't use it, you still lose the premium. Okay, but that's still bad news, because if you put £1,000 into options, this result, the shares halving in value, could cost you £1,000, and that's 100% every initial investment. Not as bad as the almost limitless losses you could face with futures, but still pretty bad. So in a nutshell, funds can make a decision about whether they try and enhance returns using debt and or using derivatives. It's well worth finding out, if you're buying into a fund, to what extent they can use those two tools. If it goes right, it can go very right. If it goes wrong, it can go horribly wrong.